Very good afternoon to all of you. On behalf of WSP of I extend my warm welcome to all of you in this 51st VCM on audit considerations while auditing property, plant, equipment, and intangible assets. This is today's VCM is 51st VCM in this council year, and we have already covered various standards on auditing. We have various webinars and VCM, as well as we have covered all the 21 clauses in 3 VCM, 5 in one VCM, 5 in another VCM, and 10 and 11 in another VCM. We have also covered various auditing aspects in Schedule 3. Now we have started, this is the first part of our this series where we are going to take all the line items in the balance sheet. And we are going to take various items to how to take considerations which we are going to take at the time of audit. So today we are going to cater 2 items, auditing considerations while auditing the property, plant and equipment and intangible assets. And in the next subsequent VCM, in the next week, we will be covering loans and advances and borrowings. Today we are having 2 eminent speakers, CA Govind Ahujaji and C. Achal Jainji, to cater these 2 important topics. So it is, I will take my liberty and it is my proud privilege to share with you the brief profile of CA Govind Ahujaji. Govindji is a partner in the assurance practice of S.R. Vatlibai and Associate LLP in Mumbai. He is having more than 25 years of assurance experience and 15 years in partner role serving listed and private companies. As far as the clients are concerned, he has catered various clients, foreign multinational companies, Indian headquartered multinational companies, entrepreneurs-led, private equity investors, professionally managed enterprises, and various startups. He is associated with IPO, launch of various IPOs, in having experience of 5 Indian IPOs in the last 7 years. And in the other engagements, he is having the statutory and group audits, SEBI listing regulations reporting, and GAAP conversion engagements. He is proficient in Indian GAAP, Ind AS, and IFRS, and extensive experience in performing audits as per Indian auditing standard and international standards of auditing. So, on behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountants, I extend my warm welcome to Govindji. Welcome, Govindji.
Thank you, sir.
We are having with another co-speaker, C. Achal Jainji. Achalji is a chartered accountant and BCom honors from Delhi University. He is currently into practice and more than 15 years of post-qualification experience in assurance and advisory services. Prior to this, he has worked with assurance and advisory practice of big four firms. He has considerable experience in providing training to the clients on Ind AS, IFRS, and US GAAP. He is an active speaker with Institute of Chartered Accountants of India for Ind AS training programs and other programs organized at various forums and various virtual CP meetings and webinars. He has significant experience in assisting clients across industry sectors like manufacturing, real estate, power, construction service, software, media, and trading. On behalf of WSB, I also extend my warm welcome to Achalji. Welcome to you, Achalji. I also welcome all the participants, all the viewers of this VCM who have spared their time at this afternoon for this very important VCM. So we moving on towards the first technical session relating to the audit consideration for property, plant and equipment. May I request Govindji to please start his deliberation. So over to Govind Ahuja, sir, please.
Thank you, sir. And good afternoon, friends and colleagues. It is again my privilege to be with all of you this afternoon to discuss on audit considerations on property, plant and equipment. I have a small presentation which I will use to take you through my discussion. After this meeting gets completed, I will share the copy with Anilji, and Anilji, please feel free to share the presentation with the audience. It will always be helpful for them to refer to it when they're looking at auditing aspects. I'll just share my screen right. So I only request Anilji just to confirm if you can see my slides.
Yes, sir. It is perfectly fine, sir.
Great. So yes, welcome to the session on property, plant and equipment. I have put together a presentation and I'll share the contents with you. Firstly, before we start the presentation, the term property, plant and equipment. If I go back in time, the accounting standards on accounting for fixed assets and auditing thereof have been one of the earliest standards to be introduced by the ICAI. Um, per, Post the introduction of Ind AS, fixed assets, which was earlier known as fixed assets, was then termed as property, plant, and equipment. And now we use property, plant, and equipment, or PPE, as acronym when we look at the preparation of financial statements and their audit. So this is a term which will be used through the presentation, although for all of you, fixed assets is something also which may resonate with you when you're referring to property, plant, and equipment. Coming to the contents, while this topic was focused on auditing, I have taken the liberty of including accounting concepts, again, more as a highlight. And we'll not spend too much time on the accounting, we'll spend more time on the auditing concepts. But the accounting concepts are important because we as professionals, as practitioners, we are able to appropriately do audit when we understand the accounting nuances. So I have introduced a few slides on these four elements of measurement, recognition, and cost included for capitalization, on depreciation, impairment, and reporting and disclosures. This is very important with the new changes in Schedule 3 and in CARO 2020. So we'll touch upon the Schedule 3 disclosures in the reporting part in the accounting concepts. Then we'll focus on the auditing concepts, and this is where we will cover up the key assertions which are important to us when you look at property, plant, and equipment. What are the various procedures we typically perform when auditing property, plant, and equipment or fixed assets? We'll go through the typical accounting and auditing issues. And again, while we're covering accounting over here, these are the principles. The accounting issues at times also impact our audit report. So I've captured both of them together. And last but not the least, we'll also then go through the auditing aspects relating to the reporting. So as we all are aware, our current CARO and the earlier CARO always had the CARO opening with assertions to be given on fixed assets or property, plant, and equipment. So we'll touch upon those requirements as well as a part of this presentation. Both for accounting and auditing, in my own practice, when I'm looking at my own audits, I generally focus on these ICAI resources. In addition to the accounting standards, I look at the guidance note on the audit of property, plant, and equipment, guidance note on the company's auditor's report, Order 2020, the guidance note on Schedule 3. We have all three divisions, one for Indian GAAP, one for Ind AS, and one for banks. And there's also educational material on Indian accounting standards on PPE, and there are various ITFG opinions on Ind AS, EAC opinions on Indian GAAP, which are available in, as ICAI resources. So these generally help me to respond to the auditing aspects, and that's why I have kind of captured them in the very first slide. So while I will share this presentation with you after the meeting, when you're going through this presentation for reference, do consider referring to the various ICAI resources, because they have a lot of rich knowledge to help you do your audits of this account caption. So this is the content for the presentation. Moving on to the accounting concepts. As I mentioned, I will spend more time on auditing, but I just want to touch upon the key aspects on accounting so that we are clear how to look at the audit side of it. Coming to the accounting concepts, when you're looking at property, plant, and equipment, the definition of, we call it tangible assets and property, plant, and equipment, there are two conditions to be fulfilled. The first condition is that the property, plant, and equipment or tangible assets are held for use in the production or supply of goods and services, for rental to others, or for administrative purposes. So the first condition to be met when any asset is being capitalized in the balance sheet. And second condition is that it's expected to be used for more than 12 months. Now, this is a condition which, these are the conditions we generally look at when looking at capitalizing any cost as a PPE, as property, plant, and equipment. But on the second condition, given the advancement of technology, many companies now may even capitalize assets which could be used for more than 12 months, but they may be having a useful life for less than 12 months. And I'll walk you through that example when I come to the accounting and auditing issues. So this is just the first aspect of the property, plant, and equipment. Second aspect is that property, plant, and equipment should be capitalized, or any cost should be capitalized as property, plant, and equipment if and only if the following two conditions are satisfied. And these conditions are, again, not new conditions. They've been there for many, many years, even in our even looking at capitalization of fixed assets. The first condition is it is probable that the future economic benefits associated with the item will flow to the enterprise. And second is that the cost of the item can be measured reliably. So if these two conditions are satisfied, then the cost can be capitalized as property, plant, and equipment or fixed assets. I think I'll use property, plant, and equipment as a term because that's our term now. The cost incurred, and I'm just trying to kind of look at the standard the way it is worded. The cost incurred, typically costs incurred on day one or initial cost recognition to acquire or construct the property, plant, and equipment. And the second cost could be costs which are incurred subsequently. So there could be certain costs which are not incurred initially but subsequently, but these costs could add to the economic benefits of the asset, or they could be for a replacement, or they could be even for servicing. Like, for example, in the case of, say, airlines, or even for that matter, shipping vessels, there are some services which actually augment the life or increase the life of the property, plant, and equipment, and hence even those costs can be considered for capitalization under situation 2. And again, these are very unique, specialized assets. So there are a lot of conditions to be considered, but I think as a principle, these are the two costs which are capitalized as property, plant, and equipment. Coming to the elements of cost, and again, some of these are very straightforward, so I will not take too much time. So, purchase costs are pretty straightforward, where you take the cost of the asset, you add the import duties, and you can deduct trade discounts. So this is very straightforward. Directly attributable costs. So when a company is constructing a plant or it's constructing an asset which is not necessarily just a plug-and-play asset like a computer or a network device, but it's an asset that gets constructed, then the costs which can be directly attributable costs for the construction of the asset, like employee benefits, cost of site preparation, initial delivery and handling, transportation, installation and assembly costs, testing costs, professional fees. If they are directly attributable to the construction of the asset, these costs can be capitalized. Again, this is pretty straightforward, but there can be some challenges in that, which we'll discuss in the auditing side of it. And the third element is the other costs. So initial estimate of dismantling costs, initial estimate of site restoration costs, and major inspection costs. These costs also can be capitalized. Again, these are very, very unique, but so there's an element of judgment involved in these. And what are the costs not capitalized? Opening a new facility, training costs, advertising and promotion activities, and admin and general overheads. So these are the areas which, as I mentioned to you, while these are accounting concepts, they really pose significant auditing issues when you come to auditing those numbers which are capitalized by any company or any enterprise. Just a couple of nuances on the cost. If the payment for the capitalization is deferred beyond the normal credit terms, and I've tried to kind of cover the Indian GAAP and the Ind AS nuances. Again, idea is not to make it into accounting standards discussion, but the nuances that is in the Indian GAAP, there is a difference between the cash price and the total payment. Then there's an interest which is recognized over the period of credit, unless the interest is capitalized because it's a directly attributable cost. In Ind AS, there's a concept of fair value of consideration. So the concept of Ind AS is different from Indian GAAP. So the concept of fair value of consideration, which would have implications in determining the cost of the asset acquired. Some examples I put over here, again, focuses on auditing. So if you look at a company or an enterprise which has capitalized pre-operative costs, trial run expenses or startup expenses, initial operating losses, if they're capitalized, these costs are generally not included in the cost of the PPE. These costs should be expensed out. There are costs at times which are incurred in connection with the construction, but not necessary to bring the item to the location and condition necessary for it to be capable of operating in the manner intended. So again, it's a very long phrase over here, but there could be certain costs which enterprise could have capitalized because it has a indirect nexus to the property, plant, and equipment. However, if these costs were not necessary to bring the item to the current location and condition, then these costs need not be capitalized. Again, these are some examples I'm using from various practices we've seen in the preparation of financial statements and in audit of financial statements. Some of these topics have been discussed in various ICAI EAC opinions or ITFG opinions. So I think these are some of the examples I'm putting over here as issues which could be accounting related but may pose audit issues. Redeployment costs, costs of relocating or reorganizing part of or all of entity operations are not included. Recognition of costs in carrying amount of PPE ceases when the item is in location condition. So when do you stop capitalization? That's a condition defined as when the item is ready to available for use as such. Replacement costs, carrying amount of the item in the PPE, the cost of replacing a part where the cost is going to enhance the life of the asset and enhance the productivity. Those costs are included in PPE. Servicing costs of PPE, costs of day-to-day servicing are primarily the costs incurred for labor and consumables, so these are not included. However, as I mentioned to you, for specialized assets such as airlines, shipping lines, or very complex plants, if the costs are going to be done to augment the life, those costs could be capitalized. Inspection costs are included. As I mentioned to you, I gave you the example of aircraft multiple times. The condition for continuing to operate PPE may be performing regular inspections for faults, regardless of part replacement. So these specialized assets require periodic checks at certain hours of flying or certain years of operation. So these costs are pretty major as such as costs, and these costs are capitalized generally. Borrowing costs, I think there is a nuance. Borrowing costs generally are capitalized in the qualifying asset if the asset is taken long to be put together. In Indian GAAP, borrowing costs are capitalized based on the company's level borrowing costs, no separate adjustments. In India, there's a concept of looking at the consolidated group's average borrowing rate, which could be considered for capitalization. But borrowing costs in general can be capitalized. Foreign exchange, Indian GAAP, there was a specific notification issued by the MCA, which kind of gave the ability for a company to capitalize the foreign exchange differences or accumulate them in the foreign currency monetary item transition difference account. This is a term defined in the MCA notification. So these costs could be in a way, kind of captured as a cost which is capitalized. But in India does not permit the capitalization of foreign exchange differences. Only exception being that in case the company has foreign exchange borrowings, then the exchange differences on those borrowings could be capitalized as additional interest costs. Componentization, this is a very unique concept again. At times when the company acquires a plant, the plant could be having critical spares, or they may be having various components. These components could be such that the component may have a life different from the life of the overall plant. So to give you an example, one of our clients, they put together a printing press. The printing press was for 15-20 crores. But in the printing press, there were certain assets whose life could have been 15-20 years. There could be certain assets whose life was only 7 years. So given that the company had the information of the various costs of the components sitting in the 15-20 crore number, each component was capitalized separately, and each component was depreciated over the remaining useful life. So this is a very unique concept again, where it was actually giving a true reflection of the cost of the asset and the various components. So I think again, this is an area which is generally judgmental, and when you're looking at the auditing issue of components, this can pose an issue as to how do you look at the various components, and there's judgment involved in this area. So we covered the cost. We'll go to depreciation now. All assets with finite useful life must be depreciated. So I think when the asset is available for use, that's a principle. Available for use is when the asset is in the location and condition necessary for it to be capable of operating in a manner intended by management. The following factors are considered in determining the useful life of an asset. The useful life, expected usage of the asset, this is a management estimate. Expected physical wear and tear depending on the operating factors. Technical or commercial obsolescence arising from changes in improvements of production or changes in market demand for the product. Legal or similar limits on use, for example, expiry dates of assets. Asset management policy may involve disposal of assets after specified time. Many companies, they may, like pharma companies, they choose to have their plants depreciated, replaced every 7 years, even though the plant life could be 10 years or 20 years. So that may also define the useful life for a company. And repairs and maintenance policies, I explained to you the examples of the unique assets such as airlines and shipping lines, where the repairs and maintenance could have impact the depreciation policy of a company's assets. So this is on depreciation. Very quickly on impairment, the various from accounting perspective, the various aspects that management looks at for assessing impairment indicators is whether the assets market value has declined significantly, whether there are changes with advancement in technology or market or economic or legal environment, or if there's a major decrease in the business or sales of the company. So I can give you an example, like the issues on impairment we generally see is that, for example, the company is in a business which is high on technology and the technology is changing very fast, then there could be a high risk of impairment indicators for the assets being used by that company. A classic example which we've seen is that many companies, when BlackBerry was a mobile phone being used for business communication, many companies had changed their systems to get emails on BlackBerry. But after BlackBerry failed, then you had Android and the Apple OS come into picture. Many companies changed their systems again. So if any company had made investments in the BlackBerry communication system, they had to then impair those investments, and then they had to kind of focus on other new technologies they had. Internally, there could be obsolescence or physical damage for impairment indicators. If the company is discontinuing its operation or restructuring its operation, or there's evidence that the economic performance of the asset will be worse than expected based on, again, market sales and utilizations. So these are indicators for impairment. Again, accounting concept, but it really poses a very big issue on judgments and estimates when you're doing the audit of a company or an enterprise where there could be an impairment indicator. So this is actually very much the accounting piece. I'll just cover the Schedule 3 quickly before we go into the audit, which is the main area for our discussion. So if you look at the financial statements presentation, we have under Ind AS and under both the old Indian accounting standards and Ind AS, the various heads which are reported in Schedule 3 are the property, plant and equipment in both, capital work in progress, again, which is common in both, investment property. Now, under Ind AS, if an asset has been given on lease or it is held for appreciation, then there's a separate classification for that as investment property. But in Indian GAAP, we still classify those assets as property, plant and equipment. Goodwill, that could be something on consolidation or on standalone. But in Indian GAAP, generally we don't see goodwill as much in standalone accounts. Other intangible assets, which is there in both. Right of use assets is a principle which we have in Ind AS on leases. Under Indian GAAP, we don't record leases on the balance sheet. So I think those are the various line items you see in financial statements. And these are the requirements of Schedule 3 revised. I'm putting these in detail. Again, this will be for your reading. But it's a very important point I'd like to highlight is that the new Schedule 3 or the Schedule 3 revised, which is applicable for the years April 1, 2021 to March 22 and going forward, this year's financial statements are going to carry significant amount of disclosures. And on PPE, the company is required to disclose if there are any title deeds of immovable property not held in the name of the company. So this was a requirement for us to report in CARO until last year. But this year, the Schedule 3 is also requiring the company to include this format in their financial statements and bring out why the asset is not held in the name of the company. It's a very onerous point. And this is again a disclosure for the company, but we are required to audit these disclosures. So I think this is what is the responsibility of the management to include in their financial statements. Where the company has revalued its property, plant, and equipment, the company shall disclose as to whether the revaluation is based on valuation by the registered valuer. So, again, it's a responsibility on the company to disclose that in the financial statements, and we will again opine on this in our CARO. The third disclosure, which is important, is that, again, there's more to do with loans and advances, but I will not touch upon this as much because we are looking at PPE. Then coming to CWIP, again, very interesting point. Many companies had CWIP, but the CWIP was aged. The financial statements may not disclose that in the the auditors may not even comment on that in their report unless there was an issue with the CWIP. The new Schedule 3 requires the company to include in their financial statements the aging of the CWIP, and these numbers should tie into the financial statements values. It should call out the projects in progress and projects which are temporarily suspended. This is for the capital work in progress, where the capital work in progress is overdue. So, for example, if the company had started a project of building a plant, say in a period of 2 years, but although already 4 years have lapsed and the plant is still not ready, then the companies are required to disclose this detail in their financial statements. They are required to give the overall CWIP and indicate where the activities have been suspended and give those details in the financial statements. So this puts an additional responsibility on the company and on auditors, because we are also going to be auditing these financial statements. So these are new disclosures which are important to be kept in mind when looking at PPE. I'll not touch upon intangibles since we have Achalji doing this in his presentation. Again, intangibles will be covered in the presentation, but I try to cover PPE and intangibles together. So I will leave this first to Achalji. On details of Benami property held, this is again a very interesting reporting requirement which has been introduced for the companies and for the auditors. So, if a company had proceedings going against it for Benami property, those disclosures are not required to be included in the financial statements in the old Schedule 3. The Schedule 3 revised, applicable from April 1, 2021, requires a company to disclose where there are any proceedings which are initiated or pending against the company for holding any Benami property. And this is also to be carrying so many details that to be given along with that. Details of this property, including year of acquisition, amount thereof, who is the beneficiary for the Benami property. If the property is in the books, then reference to the item in the balance sheet. If the property is not in the books, then that fact should be stated with the reasons. Where there are proceedings against the company under this law as a better transaction or transferor, the details should be provided for, and nature of the proceedings, status, and same, and company's view on the same. These are very onerous disclosures coming under Schedule 3 for companies to disclose in their financial statements. So now we go into our auditing aspects, concepts. I think, as I mentioned to you, that it's important to understand the principles of accounting. And now we'll go into the deep dive as to what do we really do when we do the formal audit of property, plant, and equipment. So if we look at the various assertions in auditing standards, we have addressed various assertions for assets, liabilities, income, and expenses. For property, plant, and equipment, we generally have to address the 5 assertions which are listed on the slide. The assertion related to existence, where the property, plant, and equipment on the balance sheet is held by the entity or by others for the entity. We have to assess the completeness assertion, where the property, plant, and equipment owned and leases included in the balance sheet. And this includes a lot of items on measurement, and I'll discuss that in the following slides. The assertion to be addressed on valuation covers the relating to the impairments which are required to be recorded. We spoke about impairments in the accounting aspects. Also, valuation also covers to a certain extent the elements relating to depreciation and the useful life thereof. Again, we'll discuss that in the following slides. So these are 3 assertions on numbers. These are assertions on disclosures, where the entity owns or has legal right to all the PP on the balance sheet. We spoke about the disclosures where the company has to disclose in case the assets are not held in the name of the company. And the last disclosure is presentation and disclosure. So as I mentioned to you about Schedule 3 revised, we as auditors are required to look at that the PPE and the related accounts are appropriately classified, described, and disclosed in the financial statements. So these are 5 important assertions for us to address. And now we will do a deep dive on each of the assertions in the following slides. And this is where I would urge all of you to do refer to the guide on the audit of property, plant, and equipment, and look at the various other materials or resources issued by the ICAI. They are rich in knowledge, and they will certainly help you to navigate the audit of PPE. Coming to the substantive procedures, and as I said, I'm covering each of the assertions. So C, I'll just kind of remind you, C stands for completeness, E for existence, V for valuation, R and O is rights and obligations, and P and D is present and disclosure. So we'll cover the completion and valuation assertions on this slide. So one of the first things we do when we start the audit of a company is to look at the opening balances. So the opening balances of the existing PPE should be verified from records such as schedule of PPE, ledger, and register balances. Then we look at the fixed assets register to the general ledger reconciliation, scrutinize the reconciliation between the fixed assets register and general ledger and the trial balance, test the reconciling items and understand reasons for the differences. Again, although I mentioned completeness on this slide as PP owned and leased, if you see, this is an element relating to numbers. It's to do with measurement. Look at the variance analysis, analyze the movement in the PP from prior period, scrutinizing the FAR to identify unusual capitalization and disposals. And looking at valuation, I spoke to you about components. I think it's important to understand how the company went about doing the components and looking at the various expert valuation reports if required, because valuation also impacts the carrying value and hence the depreciation charge. So this is what are the four steps one would do when you start the audit of PPE, by looking at opening balances and by looking at the fixed assets register and the various books of accounts. With this, I'll go into the second element, and this is where actually it's the heart of our audit testing, I would say. So if you look at the first is sample and scrutiny. So when we get the list of additions from the company, we typically would like to, based on the sampling methodology, identify the appropriate sample to be tested. It may be based on a number of items. It may be based on coverage to be obtained on total additions. So when we have the list and sample, we would then like to audit that sample by looking at the supporting documents such as the purchase orders placed by the company, the invoices, the receipt of the goods, the challans for import duties and other taxes if there are other levies, scrutinizing other accounts such as repairs to ascertain that new capital assets have not been included therein. So we typically do these procedures, and this is, as I said, this is the heart of our audit, that where we do the sampling of the total additions made by the company, and from there we pick up the samples and test the underlying documentation. And this helps us with the assertions relating to completeness and valuation as such. So this is the first step we would do when we do the testing of the additions. Second aspect is looking at the ownership. So in case you have land and other underlying contracts, we typically would look at the title deeds for those. In case title deeds are held by another person, such as banks or solicitors, because it may be a situation where the company is either hypothecated the plant or it's a document which has still not come to the company, then we would typically obtain independent confirmation. And this is always obtained through a request which is signed off by the client. So it's again an audit procedure which we would do to be comfortable that the assets which are there with the company are actually owned by the company. It's in their own name, and the title it's somebody else. These people are holding the title in the name of the company. For assets jointly owned with others, the auditor should examine the title deeds and agreements in order to ascertain the extent of entity's share. Again, these are things we would do to see that the ownership of assets is there with the company, and this helps us address the rights and obligations assertion. Coming to internally generated, I think this is very unique, where there could be a self-constructed property, plant and equipment. There could be improvements. There could be capital work in progress. Generally, these assets, the additions to internally generated PPE and capital work in progress is similar to what you would do in the acquisition, where one would like to kind of look at the invoices of the contractors, the work order records, independent confirmation of work performed. In all of this, we also generally look at the budgets prepared by the company, the approvals of the board, if the board has certain policies on capitalization of PPE or acquisition of PPE. So these are the various steps which we would perform in any audit when we have to kind of address the work performed on property, plant and equipment. So we'll move to the next one, which is so this is more to do with the costs. I'll just quickly do a recap. So one would typically do the 4 steps on the opening balances, looking at the overall reconciliation of the books of accounts, looking at variance analysis, and looking at various components. Once these 4 steps are complete, then one would look at the do the sampling and look at the underlying documents. One would also understand the ownership and title of the assets. And for internally generated assets, an auditor would like to kind of look at the various other aspects of contractor bills, budgets, and other records. So this takes care of the role capitalization element of a property, plant and equipment. Now, if you go to depreciation and revaluation, again, this is very important because this is an area where the company now starts expensing the cost capitalized as PPE. So generally, you would check the formulae for the depreciation computation. You compare the preceding years, and if the depreciation is going up or going down, we will understand the variations and understand the reasons. One would also examine the accuracy of the depreciation charge, looking at the various accounting policies, the useful lives used by the company, by looking at the lives which are there in Schedule 2. And these are, again, something one would do pretty much in every audit when you're looking at the depreciation expense and the property, plant, and equipment disclosures. Revaluations are generally not very common, but wherever there's a revaluation, an auditor is required to see the report of the independent expert. The auditor is required to understand that the person is actually qualified and has the right independence and objectivity to be doing the evaluation, and review the reports for the evaluation as such. For impairment, I think we spoke about what the management would do. An auditor would do something similar. An auditor would look at the external and internal indicators for impairment and discuss the management plans if they see any impairment indicators. For assets written off, where property, plant, and equipment has been written off or fully depreciated in the year of acquisition, examine whether these were first recorded in the FAR. I think I told you in the earlier slides that generally an asset which is to be used for more than 12 months is capitalized as PPE. What we have seen is, in some cases, a company may capitalize the asset as PPE and they may use it beyond 12 months. However, the company may choose to have a policy of depreciating the asset in the first year itself. In these cases, the company will still go about capitalizing the asset in the FAR and depreciating it fully. Now, I can give you an example of this. One of our clients, they buy high-end mobile phones, and some mobile phones today are costing more than 1 lakh rupees. What the company would do is that they would capitalize the 1 lakh rupee mobile phone, but because they are given to employees and mobile phones are generally a high-risk asset because they are mobile assets, this company depreciates the cost of the mobile equally over 12 months. So although one can say that it's an asset which is being used for more than 12 months, the company on a conservative basis writes off the entire cost in 12 months. So they capitalize the entire cost and depreciate the entire cost in 12 months. Now, why they do that is also for tax reasons. Under income tax, the company cannot charge off the cost of the mobile straight away because the tax authorities will disallow that. So hence the company capitalizes the cost and then they depreciate it, but they would include in the FAR because they have to at least control the asset. The assets may be misappropriated or there could be a fraud risk around it. So that's where the company records it in the FAR. And when the asset is written off, you also test the approvals and the basis for assets being written off. So these are aspects related to depreciation and revaluation. And coming to retirement of assets, where the items are destroyed, scrapped, or sold off, again, this impacts valuation, existence, and completeness. When an asset is destroyed, scrapped, or sold, an auditor is required to examine the authorization of the retirement, whether appropriate procedures for invitation of the quotations have been followed, whether the assets and depreciation accounts have been properly adjusted, whether sale proceeds, if any, have been fully accounted for, and whether the resulting gains or losses have been appropriately adjusted in the and disclosed in the P&L account. One of the key issues on items destroyed, scrapped, and sold, in my experience, is that at times there is a cash element. So there could be a risk of fraud where the full proceeds are not booked, and there could be also theft by an employee if there's a cash element to a disposal. For items which are destroyed and scrapped during the year, we also required to, as auditors, look at the major additions. So in case items being replaced, you look at, okay, if the asset is replaced, then what assets are acquired? So it's more of a comparison of that. Look at the various work orders and physical verification reports to trace the retirements, make inquiries of key management personnel and supervisory personnel, and obtain a representation that all assets scrapped, destroyed, or sold have been recorded in the books or accounts. So this is again something which we would do as auditors when we complete the audit process. This is a very important element of physical verification. It's the management responsibility to carry out the physical verification at appropriate intervals to test their existence. Auditor should perform the following: observe verification conducted by management and examine written instructions issued relevant to working capital, working papers, and assess competence of the person performing the verification. Examine whether discrepancies were there in the verification and whether they've been dealt with appropriately or not. This is a very important step. And audit is also required to test check the books of records and of physical assets with the verification report. So we are required to see that the books of records and FAR are appropriately updated. And last but not the least, looking at the frequency is appropriate or not. So if it's a plant which is very big, you can do once in 3 years, once in 5 years. But if it is a asset which is a mobile asset, then we typically tell our clients to do the verification once every year. And again, this is important even for our CARO reporting, but this is again based on nature of asset. So this is on verification of assets. So this typically covers the aspects relating to accounting, depreciation, retirement, and verification. Typical accounting and auditing issues are get them together. What is whether the expenditure is capital or revenue? This is a age-old issue of any management stroke auditor discussion, whether the expense can be capitalized or not. Available for use or put to use. Schedule 2 versus useful lives, because suppose Schedule 2 says the life should be 5 years, but the company wants to do it in 10 years. Then can the company do it? Or the company wants to do a shorter useful life, can the company do it? So that's an issue. Depreciation under the Companies Act vis-a-vis Income Tax Act. This is again an age-old problem because tax authorities see differently. This is a very unique one on accounting and auditing issues, depreciation versus impairment. In some cases, the company would like to show impairment as depreciation. So what many companies do is that, in case they don't want to show impairment because impairment looks negative, they could change the useful life and record higher depreciation cost. And that is something which we've seen at times, which doesn't give the right impression. But it should be very important that this leads to any window dressing risk of an impairment indicator. CWIP versus capital advances. So if what constitutes capital advances, what constitutes CWIP could be an accounting and auditing issue. Accounting for capital spares, we spoke about components as such. And last is disclosures of capital commitments of creditor in the financial statements. These are very, I would say, routine issues we face in every audit. But we've also seen, at least in my experience, auditing many companies, manufacturing, services, I've seen fraud risks in this caption, where there could be risks related to procurement cost of PPE. So many times the plant is very expensive or it's imported or it's very unique. Then one doesn't know the fair value is appropriate or not. So one always sees the management controls and the board controls over the acquisitions of those assets. So there could be a situation where the cost is inflated and the management or somebody in the procurement team is trying to get a kickback back from the vendor. There could be an issue with valuation of PPE for availing loans. There could be an issue of existence of PPE if the asset is already disposed or somebody has stolen the asset. And last but not the least, we've also seen a fraud risk in estimate of useful life on depreciation. So many times, if the company has an asset which can be used for 15 years, but the company wants to, depreciate it in 10 years itself, one may raise a question why. Likewise, if the estimated useful life is 15 years, but the company wants to write it over 25 years because they want to show a better profitability. That could be another fraud risk. As an auditor, we are required to be careful about. So these are the typical issues we see as auditors. With this, I will now move to the last section on reporting. And this is where our audit report comes into picture. CARO always covered assertions on PPE. So the CARO 2020 continues to have assertions on property, plant, and equipment where an auditor is required to report whether the company is maintaining proper records, showing full particulars, including quantitative details and situation of property, plant, and equipment. Same thing applies to intangible assets as well. This is a guidance. This is the extracts of the guidance note issued by the ICAI. So the clause requires the auditor to comment on whether the company is maintaining proper books of accounts. They don't. The auditor does not define what constitutes proper books of records. In general, the record should include description of the asset, year of the asset being acquired, classification, situation, quantity, date put to use, useful life, residual value, component-wise breakup. So all these texts would generally help you get to appropriate books of accounts. Record should also contain particulars of self-financed or right-to-use assets, which is the leases under Ind AS, even though they could be fully depreciated. And most importantly, the property, plant, and equipment records should reconcile with the books of accounts. So this is the first reporting in CARO. Clause 1B requires the auditor to confirm about whether the assets are verified at reasonable intervals and whether there was any material discrepancies. This reporting requirement is continued for many, many years. So again, this is the guidance which is there in the CARO 2020. And the auditor is required to complete these procedures of making the right inquiries with management, looking at the records, work papers of the physical verification performed, applying judgment to see whether the interval is reasonable or not. If it's once in 3 years, once in 5 years, is it reasonable or not? Also look at the assets leases, like India's 116 covers leases. So look at right of use assets covered under leases. Look at the agreements, whether the the company has a right for that lease. Look at the assets which are given on rentals or they are held for appreciation, or look at the assets that are held for sale. All of these also get covered in this reporting under clause 1B. And as I said, the auditor should look at that there's appropriate evidence to support that the company had verified the assets. 1C covers the title deeds. I think I spoke about the new requirement for the companies to disclose in the financial statements. So this is a reporting on that clause. Auditor is required to comment whether the title deeds of all involved properties are held by the company or not. If not, the auditor is required to call out the description of property, carrying value, reason not being held in the name of the company in its audit report in the CARO. So I think this is a very important addition to the CARO 2020 and Schedule 3, the reason for not being held in the name of the company. And the last point I want to cover is on the revaluation, whether the company has revalued its property, plant, and equipment. If so, whether the revaluation is based on the valuation by a registered valuer. If the change is more than 10%, then we have to comment on that also in our report. So this is again a new reporting requirement. This is a guidance under CARO. I have only kept the key clauses over here. So revaluation will be carried out at sufficiently irregularity, but generally companies don't do it every year. So generally you see it once in 3 years, once in 5 years. So reporting under this clause will cover upward and downward, but will not include valuations done on first-time adoption of Ind AS, any changes due to foreign exchange or interest rates, and changes to any ROU assets, such as lease assets due to lease modification. Auditor is required to specify amount of change if it's more than 10% in aggregate of net carrying value, and we are required to make appropriate disclosures in the financial statements as such. So this is what I had, and I think the last point was on Benami. Benami is a repeat of the company's reporting requirement in the Schedule 3. So we are required to again report that are there any properties which are there any proceedings against the company for Benami transactions for any Benami property held by it in its name. So again, this is a matter of fact reporting, and the guidance on this again in the CARO. These are the key elements I put on this slide over here. So with this, I come to the end of my discussion. Anilji, I'm not sure how you want to do it. Are there any questions for me in this session, or do we take the questions later towards the end?
Thank you so much. Thank you so much, sir. It was wonderful deliberation. You have taught all of us in a very lucid, very simple manner, in a very effective manner, sir, on PPE. It was really very nice to have you today at this platform, sir. Sir, due to some technical glitch, we are unable to fetch certain questions. Only I have received one question in the beginning, and I am unable to fetch certain questions. But at the end, we will take the questions. Then I'll forward it through the mail. We will get the answer. Then I'll forward to the members, sir.
No problem, sir. No problem.
So one question is, sir. So what are the employee costs which cannot be capitalized? Please clarify the cost directly attributable to the acquisition or construction.
I'll explain that. I'll just put that slide up again so that we can.
Yes.
Yeah, it will take just one minute. I'll just put the slide up first. So typically, what we see is, and I'll give an example. Okay, I'll give an example. Suppose the company is constructing a plant, and the company has a project team. A project team could be a team which is, this is the question on employee benefits. So suppose there's a project team. A project team is a team which is responsible for interacting with the architect, interacting with the building contractor. A project team is responsible for looking at the progress of the construction. So if there's a project team which is dedicated to the construction of the plant, that cost is directly attributable. Now, for the same plant, there's a finance team who is looking at the company's revenue, cost, and they're looking at this project also. Now, if the finance team cost is there for all the activities, that is not a directly attributable cost if the company is an operating company with other activities. So in that case, the finance team cost would be not directly attributable, but a project team cost would be. However, suppose it's a new company and there's no other operation. And the new company has a project team, they have a management team, they have a finance team, they have a legal team, and everybody is participating in the construction of the project. But there should be direct attribution again. And this is where there's a big judgment call as to what is directly attributable. So a finance team's cost could be considered to be directly attributable for a certain portion of time. But generally speaking, a finance team cost cannot be considered 100% for directly attributable, because a finance team is also doing tax compliance, they're also doing regulatory compliance, they're also doing audits. So a finance team cost cannot be directly attributable to a project for 100% of the time in the project phase also. So I think this is an area where directly attributable costs should be, one should see if the person is not there, can that asset be constructed? That is the test we generally follow. So the finance team is not there. Will it impact the construction? Possibly not. So you can still believe it's directly attributable. But again, as I took you through the accounting issues also, and I think my first issue, which I actually have listed over here also, is capital versus revenue. This is a classic issue in every audit. What cost is capital? What cost is revenue? What is directly attributable? What is not? Finally, that's my response.
Yes, sir. Sir, one question is related to the PV report.
Yes.
The member saying PV report is considered as an important requirement. What further steps should we perform when we receive it?
PV report, a physical verification report, correct?
Yes.
Yeah. I think firstly, when we get the physical verification report, we should first understand how was the verification done. And this slide is actually very clear on that. So understand whether the company had given written instructions. Who did the verification? Was it a person who understands the nature of the asset, or was it somebody who's just doing a tick mark? So you have to understand the competency of the person performing the verification. After the verification report is received, an auditor is required to look at the discrepancies and compare to the books of accounts. Then one would also do a test check of the PV report. So what we do, at least what I do in my audits, is me and my team, we would then, if the company has done, say, one plant, I would go and test every 10 items, every 10th item, every 20th item based on a sampling process, and see that if the asset was verified, does that asset exist in the plant or not. So I will do a test check of that. So that's the things one would do when you get the PV report with you.
Yes. And who is responsible for the physical verification of PPE? Management or auditor?
Management.
What is the major process of physical verification of this people?
Yeah, I think management is responsible for to carry out the physical verification, and ownership and existence of assets is management's responsibility. So that is that is very, very clear. So what's the second question, Anilji?
Sir, the member is asking your suggestion. What is the major process of physical verification of PPE?
Major process. Major process, you said, right?
Yes, process.
Yeah. So process is, what we do typically is as follows. I'll just give you again an example of a company with many assets and many plants or many facilities. So one is, first you prepare a plan. You work with the company that, when you're doing the audit for the year, you prepare a plan. When will the company verify those assets? Will they verify once in 3 years, once in 5 years, once every year? Once the plan is put in place, then we'll work on the company to see how the plan is being implemented. So we look at the instructions being given out. Then every year, the company will tell us when will they give us a verification report. For example, if we are doing the audit of March 22, will they give us a valuation report of the March 22 in the month of April, May, or will they give us in February, March? So whenever they give us the valuation report at that time, we look at the appropriate cutoff period, and at that time we'll compare to the books of accounts and look at the discrepancies. Then we'll do test checks of those items. So the physical verification process actually starts with agreeing with the company on the plan for the verification. And if the plan is annual, it's very good. If it's once in 3 years, then we have to be very careful whether we are covering all assets once in 3 years or not. So those are the areas which you cannot typically focus on. But this exercise is like, always done. The planning should be done very early in the year of looking at the plan for verification.
Yes. Thank you, sir. And last question is, sir, insurance paid on the purchase of new vehicle, it should be capitalized or not?
I think I can tell you what was happening in practice. Many companies, when they acquire the vehicle, be it a commercial vehicle or be it not a commercial, a passenger vehicle, when they acquire a vehicle, they get one invoice typically. But of course, maybe there could be three invoices, but they get typically one bunch of papers from the automotive distributor or dealer. So many companies capitalize the entire cost in the first year itself. But insurance cost is annual cost. So we typically guide our clients to capitalize only the cost of the asset, and insurance is typically not capitalized. So that is the approach we generally take. But I can also tell you, Anilji, in practice, we've seen both the practices. I can only, maybe not the right approach to conclude, but I can only share that from a materiality perspective, these are not significant costs. Because, when you're looking at any manufacturing company or a trading company or a service company, you don't see that many additions of vehicles coming in and insurance being capitalized. So we don't see that to be a big cost. But we recommend to our clients that they should not capitalize insurance cost.
Thank you so much, sir, for such a wonderful deliberation. On behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountant, I extend my heartiest thanks for sparing your valuable time, sir. Thank you so much, sir. Thank you, sir.
My pleasure. Thank you. Thank you.
Thank you. Thank you. Moving on the next technical session, we have with us Achal Jain ji. Achal, sir, you are there?
Yes.
Achal Jain ji, sir has already taken property, plant and equipment. Now moving on to the next session, that is relating to the intangible assets. So may I request to please enlighten all of us on various intricacies relating to the auditing aspects in intangible assets, by auditing of intangible assets. Over to Achal Jain, please.
Thank you so much, Anilji, and thank you, Govindji, for this lovely and detailed deliberation on PP, and which is going to help me quite a lot during my discussion on intangible assets, because there are certain principles on intangible assets which I can just pick from some of the discussions that we had on the PPE. So talking about intangible asset, we can just first of all discuss briefly about the definition of intangible asset. Whether we talk about Indian GAAP or Ind AS, largely the criteria that we follow in respect of intangible assets happens to be same. And one of the aspect around the intangible asset as compared to PPE happens to be the fact that intangible assets are those assets which are not having any physical substance, and that's why certain audit aspects when it comes to the audit of intangible assets become all the more challenging, and there are certain principles which are required to be specifically looked at in case of intangible assets. So intangible assets, we can say, are those assets which are identifiable, which are non-monetary in nature, and which are not having any physical substance, and which are those assets over which the entity will have the control. So let's try to pick up some examples, basis which we can then have a understanding of as to how this intangible asset will have to be looked at. If we talk about patents, if we talk about trademarks, if we talk about copyrights, goodwill, some of these assets are in the nature of intangible assets. If we talk about software, this is again an intangible asset. Now, in respect of all of these assets, one would observe that the physical substance is missing. When we talk about physical substance, so the element of the part which is tangible in nature is going to be very minuscule, or that is going to be very, very insignificant in proportion to the intangible proportion. So for example, if we talk about software, now software is also something which is generally embedded in the form of a tangible asset, say a pen drive or say any sort of hard disk wherein the software is kept. Now this software may have a value which is running into lakhs, wherein the value of this physical component is not going to be so significant. That will be running into few hundreds or few thousands most of the times. And that is what segregates this intangible asset from this tangible asset, and that is what is required to be generally looked at whenever we audit any item, whether it is in the nature of tangible asset, which will fall under PPE, or whether it will fall under intangible asset. This is one aspect. Secondly, when it comes to the identifiability control criteria, therein again, the aspect that we need to look at is whether the entity, or we can say the entity which plans to recognize this, whether they will have control over this intangible asset or not. Wherein some of the aspects which one will have to look at will be whether this asset is separable or not. And for separability to be assessed, we need to check whether this can be for the sold out, whether this can be for the leased out, or whether the economic benefits which are attached to this particular asset are something which are going to come to the owner of this asset only, and not really any other entity or any other individual. So that is how broadly we can say intangible asset is required to be looked at. As we discussed, this intangible asset definition comes from two GAAPs. So one is Indian GAAP and second one is Ind AS, of course. And in both the places, generally the criteria that we follow happens to be quite similar. Moving further on to the recognition criteria. Now, in terms of recognition criteria, there are only two aspects we are required to look at. Whether this economic benefit which we expect to generate through the usage or by having this intangible asset is going to be available to the entity which is having this intangible asset or not, and whether its cost can be reliably measured. If both of these aspects are covered, then definitely we can recognize this intangible asset. Moving on to the next important aspect of the intangible asset, and that is about the measurement. Now, like any other asset, intangible assets at the time of their initial recognition will always be measured at cost. When I talk about initial recognition, that is something that is the time when the intangible asset is acquired, or you can say that is something which is internally generated, if that is allowed to be capitalized as per the requirements of the relevant standard. So at the time of initial recognition, the cost is going to be the measurement criteria always. Now, in terms of this cost, let's try to understand what all components can come in and which can then be used for the capitalization of the intangible asset. Therein we can draw some of the principles from PPE. Now, first aspect of the cost will be the purchase price if we are acquiring this intangible asset. So now this purchase price could be the amount which we are paying to purchase the intangible asset, if that is an acquired asset, or if there are any non-refundable taxes or duties which are attached to it, that will also be capitalized as part of this direct cost only. In case there are any rebates or there are any refundable taxes that are not allowed to be capitalized along with the cost of the intangible asset. Second component of the intangible asset, I would say, is something which is more important for the auditor to be looked at, and that is in respect of directly attributable cost, or we can say the other direct costs which are other than this purchase price, etc. And that is particularly relevant in the context of those intangible assets which are internally generated, which the entity will generate internally, which the entity will be planning to come up with. And that is something I would say is the most typical area when it comes to the audit of the intangible assets. Now, in this context, some of the cost components will be those costs which can be directly attributable towards the acquisition of the intangible asset. So, for example, if we are internally generating any intangible asset, then definitely certain employees are going to be involved in this process. There has to be a manpower. The manpower cost will have to be looked at. Then some infrastructure is going to be used for this. It could be the property which the company may have on lease, wherein the lease rentals are required to be paid, or in case it's the owned property or the owned infrastructure which is used, then the depreciation on that infrastructure is is something which will be allocated towards the cost of that intangible asset. There are going to be certain costs of the consultants, of the professionals who may be helping us, or maybe entity in terms of this acquisition or generation of this intangible asset. And that is, again, if that is very, very specific to the generation of the intangible asset, that are also allowed to be capitalized. Now, these are some of the costs which one can always look at in terms of whether they have any direct linkage to the acquisition of the intangible asset or not. Only and only if they are directly attributable to the acquisition or to the generation of the intangible asset, they are permitted to be capitalized. Otherwise, they are not permitted to be capitalized. It's the same principle which we generally look at in case of property, plant, and equipment. We don't have any third component which we see in case of PPE, and that is about asset requirement obligation, because there's not going to be any sort of that nature in terms of intangible assets, considering the type of asset it is. Yeah, so if we talk about intangible assets, we are going to have only two components. One is about this purchase price and the related cost, and of course the second is the directly attributable cost, wherein each and every cost will have to be analyzed whether that is directly attributable towards the acquisition of the intangible asset or not. If that is directly attributable, that is very much allowed to be capitalized with the cost of the intangible asset. Now, moving further, when we move towards the subsequent measurement, therein some of the principles which one has to look at will be around the revaluation, and that is again something similar to what we see in case of PPE. And in case we continue with this cost model, then similar to what we do in case of PPE, we are required to amortize the intangible asset. So therein the amortization is required to be looked. I would just like to first of all touch upon this amortization of intangible asset first of all, and maybe towards the later part we can talk about this revaluation, because that is not very relevant in the context of intangible assets. Intangible assets are generally carrying a useful life. Generally you will see a useful life is attached to the intangible assets. There are definitely certain intangible assets which may have indefinite useful lives, but we are talking about those intangible assets which have a useful life and which is definite. But generally, we will not see a residual value in case of intangibles, because generally you will find the residual value for an intangible asset will be nil. Yeah, so that's why I'll just exclude this residual value for the time being, for the purposes of our discussion on amortization, which means that when it comes to the amortization, what is primarily required to be looked at is about the useful life of the intangible asset. Now, this assessment of useful life is something which is management driven, because it's the management which will decide as to what is going to be the useful life of the intangible asset. And when it comes to the management assessment, we as an auditor, we can just simply not go by what the management has told. Whenever the management would assess the useful life, they will have some justification for this. Okay, maybe there's a contractual arrangement in place, basis which we can say that this intangible asset is going to be available to the entity or going to fetch the economic benefits to the entity over that contractual period. Or maybe in certain cases, the economic benefits are available over the useful life, and that is something which the management can demonstrate through the documentation which they will have. And this is something which is the responsibility of the auditor to look at whenever it comes to the assessment of the useful life. Now, this is one of the areas which I have generally seen is missed, and generally as an auditor, we don't really get into the assessment of the useful life, because generally we believe that whatever is the useful life, and if that useful life is something which the management has represented, if the management has confirmed, then we are just simply happy to go with that useful life, and we should not really get into the audit of the useful life, which is inappropriate. Yeah, so we as an auditor are required to ensure that whatever useful life management has picked up is also justified, and that is also considered reasonable by the auditor. Yeah, so we need to challenge that. Of course, if that is something which is appropriately explained by the management with the documentation in place, then we can be happy as an auditor. Now, talking about some of the intangible assets which do not have a definite life, or let's suppose if we talk about intangible assets which have indefinite useful life. Now, in respect of those intangible assets, the accounting standard simply says that because they do not have a definite life, so that's why they are not amortized. And even if we go by the amortization principle, we will not be able to amortize it. Why? Because the useful life is not definite. So that's why in such a case, accounting standard requires the management to do impairment testing of those intangible assets on an annual basis at every reporting day. Yeah. Irrespective of whether there is any impairment indicator or not. Which means that even if there is no impairment indicator, management will be required to do the impairment test. So we are not saying that the management will have to do the impairment. No, it's only the impairment testing which the management will have to showcase that this is something which they have carried out. And this is again the responsibility of the auditor to do a checking of that management testing or that assessment which the management will have done. Now, in respect of this aspect of impairment testing, this is again one of the areas which is generally missed out, which is generally overlooked. And this is again, I would say, a very, very important area which shouldn't really be ignored by the auditor. Moving further onto the useful life assessment, wherein this amortization is something which is captured. Now, for this amortization to take place, this useful life at certain places we can always look at in terms of the contracts which are available, or if there are any sort of intangible assets which are available in the industry or which are available at other places also. Definitely we can benchmark. Yeah, so that can also become the basis for us as an auditor to look at whether the management's useful life which they have picked up is something which is appropriate or not. So there are ways to capture it, just that as an auditor, we need to just make sure that these two are the areas on which audit procedures are required to be performed. That these two are not the areas which can just be overlooked, or these two areas should not really be limited to the management representation letter. Audit procedures are required to be performed. Now, talking about intangible assets which are self-generated, I would say this is another very important principle in the context of intangible assets, and that's why I'm just picking it up because I would say this is something which is very, very subjective, and which, to my experience, has been one of the most challenging areas whenever it comes to the financial statements, wherein you see that some of the intangible assets are under development, or some of the entities are really looking at the capitalization of intangible assets which are self-generated. Now, therein, we first of all need to go by the principles which the accounting standard provides. Now, in this case, accounting standard gives us the guidance that whenever any intangible asset is planned to be self-generated, or management is planning to capitalize an intangible asset, or for which the process is going on in-house, generally which we see in case of automotive companies or in case of pharma companies, there is a separate dedicated team which is involved in research and development throughout the year, and therein this expenditure happens to be quite significant. Now, in respect of that expenditure, every time we need to look at two stages. First is the research stage, and second is the development stage. So that means if an entity is looking at generation of an intangible asset, for which they have a separate dedicated team which is working on that intangible asset for years or maybe for months, then the expenditure of that team or of that project, now the question is whether that expenditure can be capitalized or should that really be expensed out. accounting standard says that any expenditure which has been incurred, and if that pertains to the stage which is research, okay, that means any expenditure during the research phase is required to be charged off. Means that will simply go to the P&L. That is not allowed to be capitalized. Once the research phase is over, that is when the development phase starts. And any expenditure which is incurred after the research phase is over and when the development phase starts should be capitalized. Now, this is not allowed to be capitalized. This should be capitalized. Okay. So this is again not an option which is available to the company. This is something which the company is required to do. So that's why it becomes very important as an auditor as well as the management to first of all look at as to when this research phase ends and when does this development phase starts. And this area, as I have discussed, is quite challenging to be assessed. To draw a line between these two stages is very, very difficult. This requires a lot of judgment and a lot of discussions, or I would say assessment basis discussions with the management. Only then this can be properly analyzed. So let's try to first of all understand as to what could be the research phase or what could be the expenditure which the management would incur during the research phase. The research phase, we can say, is the stage during which management is only looking at the product and they are planning to come up with that product, but there is no clarity. In simple layman terms, we can say there is no clarity available with the management as to whether they will be able to develop that product or not. Means some sort of experiment is going on. Some sort of experiment is going on. Yeah. So there's no clarity which is available. So they are just doing experiments during this stage. And during this stage, various involved infrastructure is there, for which rentals could be there, depreciation of building will take place. Then we'll have consultants who may be involved in this process. So whole lot of costs which are directly attributable to these types of projects are being incurred. And we are saying those are directly attributable because those are specifically for that project only. But the only challenge is that the clarity, there's no clarity at this stage which is available with the management, or you can say management cannot clearly demonstrate whether they will be able to develop that product or not. So till the time the management doesn't have that capability, they are not able to demonstrate, we would say that is the research phase. And any expenditure incurred by the management during this phase is required to be charged. Now, let us try to understand as an auditor, what is it that we can do to draw a line between the phases, yeah, as to when does this research phase ends and when does this development phase starts. First of all, it has to be the discussions with the management. We need to understand the thought process of the management. We need to understand the thought process of the project team. We also need to understand the technicalities which are involved in development of that project. We need to understand the financial viability of the product, which the plan is there to develop. We need to understand whether the technical feasibility is in place or not. And these all things are possible by looking into the contracts which the management will be having with various consultants. Generally, the consultants are going to be involved who are helping the management team in terms of these processes. Generally, you will see consultations with the consultants will also help us as an auditor to identify as to which stage we are into. Yeah, whether we are into that stage or not, during which this research phase is continuing or that has come to an end. Secondly, we also need to look at the discussions with the management. We need to make inquiries with the management, and the inquiries or discussions that we are planning to do has to be at the right level. So when it comes to the right level means the top level management also needs to be involved. Therein the discussions have to take place, wherein we need to understand as to what are the challenges which are involved in terms of development of those projects or development of those products, basis which the auditor will be able to get the insights, and basis which the auditor will also be becoming comfortable in terms of the lines which the management would have drawn, because all of these things management would have already done. Yeah, it's not something which the auditor is required to do. Management would have already done. Auditor is there to just check that whatever management has done is correct or not. So that's why a detailed, proper understanding is required to be taken in this particular process. Secondly, when it comes to the development phase, some of the activities which we'll generally see, or some of the expenses, or some of the way the expenditures are incurred, or the activities are, or you can say that the development is taking place, is required to be looked at, because development phase is the phase when the management is clear in terms of what is required to be done and how the product is going to be developed. Development phase is the phase wherein the management is generally planning to come up with a prototype in respect of the product which is planned to be developed. And in this respect, again, some of the contracts which the management will be having, some of the discussions which the auditor will be doing with the teams of the management or the teams of the consultants will help the auditor to understand as to whether these activities are in the research phase or in the development phase. And accordingly, the accounting has to be finalized. As we have discussed, that this is something which is very, very subjective in nature, and that's why a bit of technicality is also involved, and therein the auditor may also plan to getting discussions with the management experts, particularly on these projects. And in certain cases, auditor may also plan to bring in his own independent industry experts as the part of the audit experts to help understand in case a particular project is quite challenging or a significant technicality is involved, who can then help the auditor in terms of this assessment. Yeah. So one is of course going to be the management expert or the management team, and secondly, it could be the industry expert, which at times, depending on the complexity which is involved in the project or complexity which is involved in the process, auditor may also plan to bring in, and you can then help the auditor to decide as to what is required to be done at that. Now, as we have discussed, all the expenses or any expenditure which is incurred up to the research phase is required to be taken to P&L statement. So that means that will simply be charged off. And we are talking about the accounting right now. And any expenditure during the development phase is something which is capitalized. So now, at certain times, what we see is that even though the development phase has started, management is not capitalizing. They are happy to charge it to P&L. Therein, we can't say that yes, management is conservative and that's why it's appropriate to take it to P&L. No. As we have discussed, that the accounting standard is not giving us any choice in the development phase of capitalizing or not capitalizing. If that has to be capitalized, that has to be capitalized. So that's why if the development phase has started and the management is taking it to P&L, then it becomes important for the management to change the accounting and to make sure that this is getting capitalized and not really going to P&L. Further, the standard also clarifies that in case any expenditure which has been incurred belongs to the development phase, but that has been taken to P&L. Okay. Now, any expenditure which has been taken to P&L cannot be recouped. This is what again the accounting standard requires, and this is something again as an auditor we need to look at, that any expenditure which has gone to P&L cannot be recouped. That will stay in P&L forever. All right. So these are some of the important aspects one has to look at, and which are very, very important and I'm sure you must have dealt with some sort of similar situations in some of the audits that you might be handling or you might have handled in the past. And the idea was that this area is quite subjective in nature, so that's why a lot of thought process is required to be involved in this. And in some of the industries when these are the regular mechanism, therein these challenges keep coming. So that's why the auditor need to take care of all of these areas. And in case of intangible assets, these areas in particular are very, very important to be looked at by the auditor. Yeah, so this was about self-generated intangible assets. Now, when we talk about self-generated intangible assets, I'm just excluding goodwill in this case, because if there is self-generated goodwill, that is not allowed to be capitalized. Yeah, we don't capitalize self-generated goodwill. We are only talking about other intangible assets. Now, I'll now touch upon another type of intangible asset, which is goodwill. And this is something which comes from the requirements of, or you can say the principles, wherein some another accounting standard is also involved, and that is business combination, or you can say amalgamations or acquisitions. And I'm now talking about goodwill. Goodwill, as we all understand, is the balancing figure which comes in case the acquisition would have taken place of a business. And if we talk about Ind AS 103, business combination is something which takes care of it. Now, this goodwill, at the time of its initial recognition, is required to be looked at by the auditor using the principles of Ind AS 103. So means whenever we have any intangible asset in place, which is in the nature of goodwill, we need to ensure that the principles of Ind AS 103 have been applied on this. If we are talking about Ind AS, okay, for Indian GAAP, we have another accounting standard which is billing. And similar to what we do in case of indefinite useful life intangible assets, goodwill is also not amortized under Ind AS. Under Indian GAAP, we amortize goodwill, but under Ind AS, goodwill is not amortized. Goodwill is only tested for impairment. Yeah, under Ind AS, goodwill is only tested for impairment. So that's why if we are auditing a company which is on Ind AS, then as an auditor, goodwill will not be getting amortized, but goodwill must be tested for impairment. And here again, what we need to look at is that if we are talking about goodwill, and if we are talking about goodwill under Ind AS, then irrespective of whether there is impairment indicator or not, goodwill should be tested for impairment. And when we are talking about impairment testing, there again, we are not saying that the goodwill should be impaired necessarily. No, idea is to just do this impairment testing once and to check whether the goodwill should be impaired or not basis the impairment testing result that the management will have in place. And here again, all of these testings, etc., will have to be done by the management. We as an auditor are required to look at all of these principles, look at all of these checkings, look at all of these workings, whether these have been carried out by the management appropriately or not. All right. Now, talking about some of the audit procedures, particularly in respect of all of these principles that we have discussed. In case of intangible assets, we will not be able to do any sort of physical verification. Why? Because the physical substance is not there. So that's why when it comes to the audit procedures, we will generally be looking at the documentation which the management would have maintained in respect of those intangible assets. And those documentation would generally be the contracts or the agreements which are in place in respect of all of those intangible assets, whether those are generated by the management or whether those are acquired by the management. So as an auditor, if we are required to look at whether a particular asset will meet the criteria of intangible asset or not, whether that should be recognized or not, and what should be the cost components, or when it comes to the testing of the measurement of intangible assets. Therein we need to look at all of these contracts carefully. Now, for all of these contracts, again, it's not something which is being referred to as an invoice. Generally, for these types of intangible assets, we'll have a contract in place, agreement in place, wherein the terms around all of these intangible assets would be specified. So that's why it's important for the audit team to look at those agreements, to read through those agreements, to understand the terms which are involved, to understand the terms, whether they give the control or whether they give this sort of ownership right to the entity or not. And again, basis which the management should capitalize it. Second aspect, as we have discussed in the context of intangible assets, is about the self-generated intangible asset, wherein we discussed that when it comes to the intangible assets, if those are self-generated, therein again the project team will be involved. So when the project team will be involved, so before the project team would start, there must be a management plan. There, and depending on the complexity of the project, depending on the significance of the project, depending on the amount which is involved, generally the management would have planned, and those plans would be documented. Generally, the management will also have approvals in place in respect of carrying out those projects. So that's why, other than the inquiries which the auditor would perform, it's important for the auditor to look at those documentation, to have discussions with the management, and generally in case of significant types of contracts, there will also be board approvals. Yeah, so the minutes of the board meetings will also help the auditor in terms of getting some insights around some of those projects which are in place, and which will also become a good documentation or a good document, or I would say good evidence for the auditor to really look into in respect of all of these projects which the management will be looking at. Secondly, when we talk about goodwill, now in respect of goodwill, once again, as we speak about goodwill, goodwill is something which is generated in case of acquisition of business. So that's why whenever we have this acquisition of business, therein again the contract would be in place, contract for acquisition of business. Now those acquisitions which the management would have done, the company would have done, they would also detail out various components of purchase price allocation. Purchase price allocation is the exercise which the company would do in respect of doing their accounting at the time of acquisition. So now for this purchase price allocation to be looked at, first step which the auditor will be required to look into will be the documentation or the agreements in respect of the business which is getting acquired, or which the business management would have acquired, and to get into the terms and to read carefully those terms and make sure that all of those terms are something which have been captured in the purchase price allocation workings by the management. The second procedure on the part of the auditor will be to get into the audit of the PPA. Now PPA is nothing but the purchase price allocation. Now basis the audit of the PPA, auditor will be able to verify the valuation of the goodwill. Because using the PPA, using this purchase price allocation, what do we derive? We derive the value of the goodwill. Because how do we get into the valuation of the goodwill? We start with the purchase consideration. From the purchase consideration, we are required to reduce fair value of the net identifiable assets. And from this, we will reduce any deferred tax impact which is there on those fair valuation of net identifiable assets. Now here again, during the course of this purchase price allocation, particularly in case of acquisition of business, certain intangible assets could be there in the business which has been acquired. There could be certain intangible assets in the business which has been acquired, but those intangible assets were not recognized by the previous business owner. Now, This is something which Ind AS 103 requires the company to do. That whenever the business will be getting acquired, at the time of purchase price allocation, if there is any intangible asset which pertains to the business which has been acquired exists, then those intangible assets are first of all required to be identified, and once those are identified, they are required to be recognized. So let me take one example from this. Say a company has acquired another company, and this another company, let's suppose, was dealing into, say, manufacturing of bottles. Okay, say that was dealing into manufacturing of bottles. Now this business has been acquired, and the business is manufacturing of bottles. And this business which has been acquired was going on for last 20 years. And the old business which has been acquired, then this company had a dedicated customer base. Say they were dedicated to the company for last 20 years. They were attached to the company for last 20 years. And there was also some of the customers with whom the company had long-term contracts, which are yet to expire. Yeah, so the long-term contracts are going to stay for, say, next 5 to 10 years. So they also moved to the company which has acquired the business. All right. Now, in this case, the business which has been acquired, may have two intangible assets. Or you can say two types of intangible assets. One is the long-term contracts. Now, those long-term contracts would not have been recognized by the old business, by the company which has been acquired. Correct? Why? Because that will not meet the criteria of intangible asset with the acquiring company. Second is the customer relationships. Customer relationships, we are talking about those customer relationships which have been continuing for last 15 to 20 years with the acquiring company. Why? Because that is again something which would not have met the criteria of intangible asset with the acquiring company. But can we say that these two are types of intangible assets? The answer could be yes. I'm not saying that will always be yes. This could be yes. Why? Because these two are definitely the intangible assets, and they may have some economic benefits which are attached to it, and which are going to provide the economic benefits for, say, next 5 to 10 years to the acquirer company. Yeah, and the valuation for these two types of intangible assets, would have been included in the purchase consideration, isn't it? Because the acquiring company, okay, or you can say the seller, would have included this valuation in the valuation of the business. Otherwise, he would not have sold the business without getting the value of these two types of intangible assets. Now, let's suppose if we do not capture the value of these two types of intangible assets, then what will happen? Say the purchase consideration which was paid was 10 crore. Purchase consideration paid was 10 crore. And the fair value of net identifiable assets, we are talking about all assets, less liabilities, was, say, 9 crore. So 10 crore was paid, 9 crore is the value of assets and liabilities acquired. Now the difference between these two, 1 crore, will go to what? That will go to goodwill straight away, because goodwill is nothing but the balancing figure. But we understand, what do we understand? That in this case, there are two intangible assets which are existing, for which this 10 crore includes the value of these two intangible assets. Let's suppose the value of these two intangible assets is, say, 40 lakhs. So ideally, if we look at the accounting of the acquirer company, what should they do? They should record net identifiable assets at 9 crore, these two intangible assets at 40 lakhs, and the balance amount should then be allocated to goodwill, say 60 lakhs. Correct? Balance amount should then be allocated to goodwill 60 lakhs. But if we do not recognize these two intangible assets, then the amount of these two intangible assets would then be subsumed with goodwill, which is inappropriate. So that's why at the time of this PPA, this exercise of identification as well as recognition of intangible assets become important. And this is again another very important area which is required to be properly looked at by the auditor. Generally, what do we say is that the auditor is happy checking the workings of PPA. So whatever PPA management would produce, auditor would check it, and auditor would make sure that arithmetically the workings are correct. Or if there are any reports which are available in respect of fair valuation or in respect of business acquisition, auditor would also be looking at. But some of the intangible assets, which the value of which is now getting subsumed to goodwill, is something which is also required to be properly which has been carried out by the management. Management should be able to demonstrate. So this is another very, very important area which the auditor should not really overlook, and basis which the valuation of goodwill will also change. So we can say, in a way, whenever the goodwill is getting captured, the valuation of goodwill is something which is reasonable or not is very, very carefully required to be looked at by the auditor, and this assessment is also something which is required to be carried out by the auditor in a proper manner. Correct? All right. So now moving further in terms of the reporting requirements. Now, when we talk about CARO, so CARO also captures briefly about the intangible assets. CARO also captures briefly about the intangible assets. Now, similar to what we see in case of PPE, CARO requires whether the company has maintained the proper records of intangible assets or not. Now, let us try to understand what could be the proper record. Now, this proper record is not something which has been specifically given, but when we look at the guidance note or when we look at some of the aspects which can be considered in case of proper records, one can always say that it will comprise of the description of the intangible asset that should be properly captured by the management in terms of its documentation of intangible assets. Then the next thing could be about the situation of the acquisition, the date of put to use, though the date of put to use is not really relevant in the context of computing the amortization, but date of put to use is otherwise important to really assess as to when this intangible asset has really started getting activated. And then, of course, the amortization of this intangible asset is something which has to be included in this, the original cost or the WDVs year on year, which will be there in respect of intangible assets. So this is another important documentation which auditor has to ensure that the management has in place. Generally, these are not available with the management because generally you'll see the practices of maintaining a fixed asset register wherein the management will capture mainly the information of tangible assets, that is PPE, not really the intangible assets. But this is one aspect which the auditor should really require from the management and should make sure that the management has all of these documentation in place for the auditor to really comment upon when before really talking about the CARO report. Yeah. So I think this is what we had particularly in the context of intangible asset and in respect of I would say a discussion on the intangible asset, and I think I've mostly captured some of the areas in the context of intangible assets. Now, happy to have a discussion around your questions or queries in respect of whatever we have discussed. Over to Anilji.
Thank you, sir. Thank you so much for your this explanation relating to the intangible assets. Again, some issue in the questions answer session. We have received one question only. Maybe meanwhile we will fetch other questions. Sir, this is relating to the broadcasting and movie distribution rights. Member is asking this: is this broadcasting and movie distribution right is an intangible asset or expense out of media company? Sir.
Broadcasting and movie, so the other one is, yeah, I can hear you.
Sir, broadcasting and movie distribution right is an intangible asset or expense out of media company?
See, I would say one will have to analyze whether this would meet the criteria of an intangible asset or not. When it comes to the broadcasting, definitely, if this would meet the criteria of an intangible asset, we can definitely capitalize this as an intangible asset also.
So one question is relating to the capitalization. Sir also asked whether if someone starts sugar project, they are conduct some PEV, that is the third party evaluation of viability, whether such cost can be capitalized.
I've not been able to understand you. If you can just please repeat this.
Govind sir, I request you, sir, kindly put light on this question also. Question is this: if someone starts sugar project and they are conducting some PV third-party evaluation of the viability, whether such cost can be capitalized?
No, I think if you're doing a project and you're doing feasibility or viability, so those costs are not project costs. Those costs are expensed as they are incurred.
One more question is, sir, relating to the fixed asset register. If in many of the times fixed asset register, vendor names etc. are not given, and client usually says that it has been the same since past so many years. So how to handle this in the fixed asset register? If the name of the party, name of the vendors are missing, and the company is saying and that these are the so many old vendors, so that is why we haven't mentioned the name of the vendors over there. So how to give this situation?
So the way I see on fixed assets register is as follows. The objective of the fixed assets register is to have appropriate record of the assets which have been capitalized in the books of the company. So if you look at the slide which I had shown, I had indicated to you what constitutes proper books of accounts or proper records includes various factors: nature of the asset, quantity of the asset, date of purchase, amount capitalized, useful life. Now, in that, if one field of vendor is not there, that cannot be a deciding factor whether it should be there or not. Most important point is that does the company have control over the fixed asset register and the control over the existence of the asset, so that when the asset is verified, is it matched or not? So having a vendor detail is not a critical aspect if the company is then able to trace that to the vendor. For example, if I have got a plant and the plant has a warranty. Now, if I don't write the name of the vendor in the fixed asset register or in the records, but if I have a need to exercise the warranty, then if I'm able to go into the fixed asset register, into the asset code, identify which asset it is, and then from my other records go to the vendor name and go and avail my warranty, that should be good enough. So that one field is not the only critical aspect, Anilji. We have to look at the overall governance of the fixed assets area.
Yes. So one member is asking about the some tips to audit by this goodwill and impairment asset.
Goodwill and
impairment asset.
Impairment asset.
Yes.
Okay, so when it comes to the goodwill, as I have discussed around goodwill, goodwill is something which is generated in case of acquisition of business. So most important aspect around goodwill testing will be to look into the PPA, purchase price allocation workings, and also the documentation which is there in place for the acquisition of business. This is which will be getting insights whether the goodwill should really get generated or not. Most of the cases will see goodwill getting generated, but idea is to really look at as to what should be the valuation of goodwill in this case. Secondly, once the goodwill is generated and once we have recognized and that is in place, so goodwill is not something which is amortized under Ind AS if we are talking about the Ind AS accounting. And goodwill is only required to be tested for impairment. So we are not necessarily requiring to impair goodwill year on year. We are required to test the goodwill for impairment year on year. If there is an impairment, then definitely the impairment has to come in. Otherwise, we'll only keep testing it for impairment annually.
These were the two questions we have fetched at this particular time, and rest of the questions whenever we will receive, because some of the technical glitch, I will forward to Achal sir as well as the related questions to Govind sir, and the relative answer will forward to the question to the member sir. So once again, thank you to Achal sir also for such a marvelous deliberation, and over to Govind sir also. So both these speakers towards on behalf of AASP of ICA, I extend my heartiest thanks for spending your valuable time for this marvelous deliberation, sir. Thank you so much, sir. Thank you, Govind, sir. Thank you, Achal, sir. Thank you, sir.
It's our pleasure. It's a privilege. Thank you.
Thanks everyone.
Thank you. Thank you, sir.